The 3-day weekend has traders staring at walls, but there's a lot to go over. We had a lot of movement last week in the financials. We had some economic data that was misunderstood, which caused a little bit of panic later in the week. But more importantly, 20% of all financials are coming out right now with earnings. We need to decide where we actually are in the economic cycle, what New York Stock Exchange margin debt percentage growth is telling us, what sectors outperform during this phase of the economic cycle. We're going to dive into bear market probability model created by Goldman Sachs and what it's telling us right now, as well as dive into certain stocks that are coming out with earnings next week. It's going to be a big one. Let's get to it. Hey everybody, welcome back. For those that are new, what we do is go over what stocks to watch for next week, the indexes. I go over the pertinent economic data that we need to watch for next week, also the pertinent earnings we need to watch, but I try to go over more macro on the weekends than the daily videos. So if that's of interest, you're going to want to subscribe. I give my opinion on them. You look in data, you can look at data several different ways, but what we want to focus on here is what's going to actually make us money or has the most potential to give us an edge. So if we're taking a look at this, it's pretty glaring, right? This is the weekly S&P, and we can see that. We can see how we tested this level over and over again. We can see how every rally over this level is just failing left and right. It's just rejection after rejection up here. You've only had one close over it in all of 22 after it cracked. So when you see things like that, you have to understand that you're looking at a major resistance level, and we're looking at this on a weekly chart. So it's definitely something that is on your radar, and it should be on your radar if it's not. Technically speaking, they did us a huge favor in the short week. Right here we have a doji. It's almost a classic doji looking at it. So they are signs of uncertainty, and this is right under that resistance. So really, if we see the S&P break below the low of that level, which looks like 40.69, then that's going to be a problem for us, and that's not something that we're going to like. So we're going to want to watch that level. Matter of fact, why I'm doing this, I'm just going to click it right here and put an alert there. So I would really watch that level. You don't want to crack that. You definitely don't want to. It doesn't matter the news or the reason, but you don't want to have an outside week to the downside when you're at a resistance level. That will trigger selling, specifically for tech traders, technical analysis traders will look at that and go, oh no, I'm not going to fall for this again or fall for this kind of move again. I'm just going to get out of the way and let it set back up. Now, sometimes you can have reversals on that and have really good news. And we could have good news next week. There's a host of companies that are coming out with earnings. We're going to get into JP Morgan. First Republic actually this weekend said a statement on when they're going to have their conference call. So they scheduled their conference call, which should be pretty interesting. So anything like this could have some news associated with it. We'll get into the individual names, but you can see Meta, how that's setting up here. You can see how NVDA is still setting up despite what people are thinking. So when we start to see this, it is possible for an undercut and then a reversal of like a bullish engulfing. That the probability of that happening is slimmer than the probability of cracking this and going lower. And if we're traders, we have to play the probabilities. And there's a lot of data that we should be somewhat concerned about. Now, in front of us is the Goldman Sachs bear market probability model, and it's actually being calculated out. I'm using 20 years here. It's being calculated out by Sediment Trader. Now, we need to dive into what these components are. So these are 5 components that make this. It's very simple. It's the unemployment rate, manufacturing index, the yield curve, the inflation rate, and the PE ratio. Those 5 make up the index. Now, the line above is the red zone. And this is the zone where if you're over, the probability of a bear market is greater. If it's lower, then the probability of bear market is less, meaning that this is absolute pessimism in the market based upon that 5 criteria, not based upon your feelings, based upon that 5 criteria, right? So if we take a look at that, anything over here is optimism that you're going to see a bear market. Now, we're seeing it come down, and at the same time we're seeing it come down, we're seeing the market start to go higher. Now, I don't mind that it's coming down. I like that it's coming down. The problem is that if you take a look at this particular reading and those 5 indicators, that every market that we've ever had when we've had like an 09 bottom, you are deep in the green on those 5 indicators. And this is telling us that we are nowhere near that. A matter of fact, if you go back and take a look at all of these, And this is why it's so important to look at data, because everybody looks at data a little bit differently. Data is open to interpretation, and the way that I'm looking at it is going, let's just take from here over, and I'll show you what I mean. So if I start here at the high of that, and I just come all the way over, that is one of the highest readings that we've had on this in over 50 years. And that's because of those 5 indicators that we just went over. Now you could say it's skewed because you're dealing with inflation and we didn't have inflation. Well, we had inflation in the 80s and we weren't skewed the way that we are. So is this out of whack? Is it out of date? I don't believe so. I believe it's something we're going to have to watch. Now, it's very possible that you work this off and then start coming back up again. That is a possibility. And you'll note that it has really not pulled back since we hit the pandemic. It really has not had any major pullback. And even now when it's at lows, and we're going to zoom in on this now, but even at lows where you are now, if you go out 3 years and you just see how it's dropping right from that peak, at the same time, the index is going up. So is this something that we're going to have to just say, geez, we have to stay out of the way because of this? No, but it is something that we start going back through 10 years, 15 years, 20 years to be that out of pocket on those 5 criteria that we just went over, and we can go and find an exact area like 1980, which is very similar to there, it does give me a little bit of concern. So this is the one thing that I am being very cautious of, and I am watching very carefully those 5 indicators that we just went through. But if I look for signs of fear, here's the BBB, AAA corporate bond yield spread. For those that don't remember, really this is just telling you the difference. This price right here is telling you the difference between BBB bonds, right, and AAA bonds. And right now it's roughly 90 basis points, and it's actually getting stronger, which is exactly what you want to see. I'm not seeing any fear there. And let's go see if I'm seeing any panic anywhere else in the bond market. This is the MOVE Bond Market Option Volatility Estimate. Now, why do I have this up? I have this up for a couple of reasons. We can see the peak right here, and we can see that, yes, we're up a little bit. And that's 20% of all financials are going to come out with earnings this week. So it's going to be a pretty big deal. But if we look at that, and we'll get into that shortly here, but if we look at this, okay, so we upticked a little bit, but that's nothing compared to where we were. I mean, just think about this. The bond volatility estimate, we lost Credit Suisse. You had $17 billion in bonds go under. And at the same time, if we take a look at this, we're not even where we were in October on this level. So they're not really afraid. We're not seeing fear. And there's something else that's absolutely glaring about what I'm going to show you here. And we've looked at this in the past, and I think it's worth paying attention to again. So I show that bear market volatility index because as a trader, it's your job to look at everything. It's your job to not just look for the stuff that you agree with, but you have to look at everything. If you only look at the stuff you want to look at to meet your criteria, it's called confirmation bias. So we can see the peak right here on MOVE. The orange line is the S&P, and we've gone over this before. We can see how this telegraphed down the line that, yep, we sold down more, but this was more towards the tail end of it, not the beginning of it. So I'm wondering if there's a possible, let's just say another shakeout, maybe, but here we are in that pandemic low, and you can see that's marked by the bond volatility index, and we're actually higher than we are here than in 2020. But that sort of makes sense when you think about that bear market model that I just showed you, right? Because we were higher on that as well, but you've only been this high 3 times, right? I mean, candidly, it's here, and here. I mean, they're the only times that you've been this high. The last 2, and it's only 2 data points, they marked the bottom. Maybe not right away, but eventually this put in your bottom. So for now, we're going to go on the premise that maybe there's another leg down, maybe there's not, but we're more towards the tail end than the beginning of the meltdown. Now in front of us is the smart money, dumb money confidence. And that is the red line is dumb money and the blue line is smart money. And as everyone's aware that's been with us for some time, that's not how we refer to it. Make sure that you subscribe to the newsletter. I go over this daily and we are starting to revamp it. We actually revamped it over this long weekend so that it'll start coming out again daily. I had some help with it, setting it up. And it apparently through Twitter now, they're going to start blocking the links to other newsletters. So just make sure that you are getting the newsletter down below. You never know what Elon's going to do there. But we cross out smart and we cross out dumb, and we refer to this as retail and we refer to this as institutions. Why do we do that? We do that because, frankly, retail's been the ones that have been getting it right. Retail's the one that bought in October lows when institutions were selling to retail. So who did you want to be here? Well, I would rather be a net buyer in October than selling at the lows, which is exactly what they did. So when we start to see that, I don't want to really call these what they are, what people refer to them as, because I don't think it's very accurate. So, something to think about. Now, here you could actually argue that from the pandemic levels going into it, that it was all institutions, and institutions nailed it, right? But at the same time, you could just see how retail just sold the whole way through it. But now it seems like they're getting a little more savvy, and we're seeing this again. And now you're seeing that cross. The last cross we had was back here in January. Then you had another one that just happened here, but this cross was us to the upside. That's referred to us as retail. And then coming back down, retail to the downside, which was 3.9. Where'd the bottom come in? Well, the bottom didn't come in because of smart money, right? Or institutions. The bottom came in because of us at 314. That's the bottom. And that's when dumb money, quote, retail, started buying. Now, the question is, are institutions going to sell down again and get outperformed again by retail? And I don't think so. So if I zoom in this on a 12-month and I start looking at this little turn that we started to get on 4.6, and let's go out year to date, you'll note something here that started to happen. It started happening on 4.4. They start flatlining this area going into earnings. And the question is, why are they doing that? Now, there could be a couple reasons why they're doing that. They could be doing that because 20% of all financial companies are going to come out with earnings this week. Jamie Dimon issued a statement this weekend where he said very clearly, yes, you might lose another bank or two. It's a little more cavalier than I expected him to be. He said, but we do not have a systemic problem to the market. Schwab issued a statement, which we're going to go over that stock in detail. But if you look right here and you really get into this, you can start to see that they have made a decision that smart money is stopping, and guess who's got their foot on the gas again? Retail is stepping in. So we have to look at all the data points, right? And right now this is telling you that you have the cleanest line of going sideways that we've had all year. Now, if we go back 6 months, do you have another period of time? Yep, you have this little period of time in here where we did something similar and we just vacillated. So it's possible we just vacillate in here for a little bit. But I do find this interesting that you're doing this right before earnings season. Now, to dive into the technology names, and we're going to get into detail here about what stocks usually outperform right now and when do bonds outperform. We're going to get into some pretty specifics here in a moment. But I want to just go through the tech here. Take a look here. Just look at the technical analysis. I mean, this is pretty glaring stuff, guys. And I'm not sure that you feel the same way about that. So I'm just going to point out these, these little markers that I think are just absolutely glaring. You can't miss them where you're having these shoulders and you're having these retests. And I don't care what you call it, but here's a W and then you flip the W right here, right? And then when you flip the W, you do it on a bullish engulfing that completely encapsulates the other bar in 4 or 5 other weeks. Yeah, that was 3 weeks ago. You never looked back from there. So we can sit here and say, we're going to roll again. We're going to do this. We're going to do that. Right now, the market does not care what we think. Now, they've done the same exact thing here, which is beautiful for us. They have given us this doji. And I'll tell you right now, the way of the doji is the way that I will be trading this market. Right now, you're seeing uncertainty, but I like having this kind of level here because it makes life very, very easy. Small ranges, like we had this short week, if you break one way or the other, that's the way that you're going to wind up leaning on tech going into next week. It's just the way that it is. Most technicians are going to look at that. They are not going to want to be here again when that breaks and then hoping and waiting and seeing. They're not going to want to be up here again and have a breakdown, right? You never know if you're going to have a breakdown. You don't know what the ramifications are. We have not had a large bank come out and pre-announce earnings, and their earnings are Friday. So maybe we're starting to see some money being put to work because we're not seeing those pre-announcements. That's always a possibility. Now, one of the things we keep hearing is about the underinvestment. And this is really important for us to understand the underinvestment before we start going through the economic cycles, where we are in the economic cycles and what to look for next. First and foremost, this is New York Stock Exchange margin debt percentage growth. I'm not charting at market cap. I'm charting the rate of change. And there's a couple things to take away from here. Number one, this is the lowest reading that you've had in 10 years on the New York margin debt percent of growth. In other words, this is the fastest drop and the lowest on a percentage basis of that drop that we have had in 10 years. Now, if you go to 15 years, you're going to see something called the Great Financial Crisis, and you'll start to see how that marked the bottom. Go out 20 years. Nothing, all the way out. Okay, now you're starting to see some other areas. 2000, financial crisis. So if we take this line from where we started to turn and we just put a line there, and what we're going to do is just go straight across and mark everything else over. Right, and go, okay. So while we're looking again is rate of change. How fast did they get out? They got out just as fast as they did in 2000. They got out just as fast as they did during the Great Financial Crisis. When did we start seeing some signs here that we had a potential bottom in? Okay, that potential bottom came in when we started to rally and when they started to put back on margin, right? That's when we started to see that. So whether or not we're going to look here or not, it doesn't matter. What you want to do is focus on these kinds of areas and say, okay, well, if we came in here and then we just kind of look at that and go, well, that one didn't really work, did it? I mean, if they did during that period of time, they kind of got ahead of it. They were actually buying on margin at the same exact time we were going down, right? That's not ideal. That's not what you want to see, okay? So now we don't want to see that. We don't want to see them going out there and putting things on margin like that. So what we want to see, these are going to have to move. I'm going to clean this all off. So what we're going to do here is put that one line back so that we can see it, so you can understand where I'm going with this. And what I'm trying to do is I'm trying to look at the turn and see if we can learn something from the turn. And the answer is, I think we can learn a couple things here. Number one, the percent of margin was substantially higher here than it was back during this period in time, which was what? The Great Financial Crisis, right? So if we're just comparing these, and we're just comparing them only 10 years out, which is fine for what we're about to go over, and we look at that and go, well, this was substantially higher. Well, this went lower. Does that mean this has to go lower? It depends. It does not mean that. Unless the financial conditions get to that level, it does not mean it has to go this low, because you're not going to have that panic. And this is what I was talking about when we were looking at certain levels, right? We were not seeing that panic at all. And I'll show you what I mean on the Nasdaq here in a second. But if you take a look at this level and you realize that by the time you started turning, that was it. It was on, and then we started moving. And anything under this negative 25 line seems to be enough to trigger for whatever reason. I don't have an answer for you, but that did trigger us here again on the way up. So if you start seeing New York Stock Exchange margin debt percentage of growth, and that's of interest to you, make sure you follow along. Make sure you comment on this video today too, because I'm really getting in depth in some of the things that I look at. I'll follow it up in the newsletter, link in description, but comment on this, because during the weekends we have a little bit more time than just getting into the actual specifics, right? We get to be a little bit more tactical right now. Now, one of the things that I try to hammer home with everybody is data is data. What you do and how you interpret that data is completely up to you, okay? I tend to look at things a little bit differently. If you look on social media, everyone will say the high-low ratio is bad, and therefore, since it's bad, I'm bearish. Well, that's one way to look at the data. The other way to look at the data would be to say, okay, well, what happens when we get to that zero line? In other words, when the high-low ratio is so bad, what happens there? Well, if we take a look at that, we have that little area right there where it happened. Here's October where that happened, right? You're right down here as close to that zero line as you could possibly get. And that happened again in here in June. So the last 3 times we got to this level, what exactly happened? Well, it's pretty clear what happened. Market rallied, okay? And it put in a low. So it's possible that all we did was just work off the overbought of the high-low ratio. And now what we're going to do is wind up pushing and going higher. So you have these peaks right here, and you can see how those peaks are tied directly in. But it's not a be-all, end-all. You can see how this peak, and then you rolled back down. So you can't just use them for what they are. You have to use them and interpret them with other data points, right? It's just one data point. But if you start looking at this and going, well, I mean, that's pretty glaring that even when we started to sell down, we hardly went down anymore. So where are we really going here? And then if we just kind of look at the overall health of the market, below is the McClellan summation oscillator. And what you can see is that we had the little cross right here. And since that cross, we've just been staying above, which is pretty normal. And if you take a look here, you're seeing the same exact thing from that January 4th cross, and then we hit new highs. You can see that the cross, the bear cross right here, basically called the top of the market right in here on the New York Stock Exchange, NYA, New York Stock Exchange Composite. And you can see how these crosses are it's just absolutely glaring, right? You had some nonsense in here, but we're not flatlining. So this is a little different. Could you get something like this that comes up and it's only a short little hump and comes back down? Absolutely. 20% of all financial companies are coming out with earnings. I expect a lot of volatility this week. But this, again, is another data point that I don't know that I'd be betting against right now. Matter of fact, I'm not. I'm leaning towards being a net buyer. I was pretty active last week as far as buying. But let's get into some of the ideas here and some of the other indicators that you need to watch. Now, if we look at TLT, what I like about this is you're finally setting up. And what I mean by that is higher low, higher low, higher low, higher low. We love higher lows. We love to see that because all that's telling us is that you are drying up. Now, the question is, why aren't we moving as fast as we did on the inversion, right? Because you have that whole inversion out there, and I won't get into it now because we really have some things we're going to drill into that are actionable, but I do want you to understand this. So this is TLT, and it's relative to IEF. IEF is 7 to 10 years, TLT is 20 years, right? So here you have 20-year bonds, long end, and the relative performance to the short end. How'd that go in 22? Okay. How's that going right now? All right. So this is telling you everything again. And what do I mean by that? They're buying the long end. It might not look like they're buying the long end, but they are buying the long end. Okay. And that's what you have to take a look at. This is like turning an enormous ship. In order to start buying the long end, because of the amount of paper that's out there, it takes longer to turn. But when it turns, you're going to start seeing the inversion go away. And when you start seeing that, that's going to get us into the market here. Now, I like this a lot, and I would strongly recommend that you take a look at this TLT IEF. It gives you a really good indication, and I'd pay attention to that. XLY, so this is consumer discretionary, looking at consumer staples. And let's look at this on a weekly to get a better picture, because this is going to lead us into the economic cycle so you can kind of understand where we are right now. So if we take a look at this and we take a look at how we're doing retail versus staples, Clorox versus going to Amazon and buying something you want. So if you think about it, you've broken out and all you're doing is just forming a flag. You're not really breaking down in here. So we don't really have something here that we could look at and feel really negative about. Now, the one thing that I would say that I think is super important before we get into where we are in the cycles is take a look at high yield bonds. Okay. High yield bonds, because we went over the yield curve there a moment ago, we're getting ready to break through the 200 week again. I'm setting up a flag right under it. This is exactly what you want to see. Right? I know everyone's going to tell me they're going to look at copper futures and say, Dr. Copper, it's going down. Is that going down? Because to me, if I look at copper, I'm still higher than I was from the bottom of the market. I don't see that it's going down. And I think people put way too much effort and energy on copper right now. I'd be looking at gold, and what is gold telling you? Gold's telling you that there's a ton of uncertainty out there and they are scared. It's the same thing that move is telling you, right? There's a ton of uncertainty and they are scared. So if they're scared, yeah, you're not going to go out there and buy a bunch of copper. But as things get better, you're really not going to have a choice. Now, there are 4 phases to an economic cycle, and we're going to cover this cursory. And then if there's an interest, comment below and I'll get into portions of what I'm about to go through in these several slides. during the weekday. I'll break it out in portions. So if you can just look here, but your comments are how I create content, and I keep getting asked about the economic cycle, so let's do it. Encyclopedia Britannica. And what you're looking for is, where are you? Are you in expansion? Because if you're in expansion right now, that's IT, financials, communications, consumer discretionary, right? Your Meta, your Amazon, your Goldman, your JP Morgan, your Charter, your Comcast, things like that, IT, and the names that are in XLC, right? Also, you could say information technology. You can put Oracle in there. Depends how creative you want to get with what you refer to as IT. Now, that's expansion. When we peak, we see the financials peak. We see energy and materials peak. When you go through a contraction phase, you see the panic. So you buy your utility companies, you buy your Procter & Gamble, you buy your UNH. And in between all these major cycles, you have mini cycles. And you're noticing that week over week as we're watching rotation right now into XLV, which we're about to go over, and XLP. So are we in this stage? Well, it's possible that you're in this stage, but you're in a mini stage of this. And we're going to get into that in a second. But if you look at the outperformers, real estate, industrials during the recovery phase, does it feel like we're in a recovery phase right now? Right? Does it feel that way? We're looking at real estate. Are you looking at what industrials are doing? Doesn't really feel that way, right? Is it possible that we've already gone through this? Well, we're going to discuss that in a moment. Now, this is a great graph by ACG Advisors. I did not create this graph. And if you just take a look at this real quick carefully, what it's going to do is say, hey, well, how do I know what phase I'm in? That's great what you just told me, but I don't know what phase I'm in. Okay, you can screenshot this and just look at it from here. I'm not going to create it. Actually, maybe I'll put this in the newsletter and just give them credit for it. So make sure you get the newsletter. I'm probably going to do write-ups on these pieces so that people can utilize these. I think it might be a good idea so you can understand this. So are you in a recovery phase? Well, do we have stimulus and economic policies right now? No. Has confidence picked up? No, it has not. Is inflation falling? Yes, it is. Okay, well, that's interesting. So 1 out of 3 is not bad. What is the market doing? Well, short rates are low and falling. Well, they're not doing that, are they? Bond yields are bottoming. Well, the long end seems to have bottomed, doesn't it? Stock market's rising. It is. Commodities are rising. Well, that's interesting because gold's rising and copper's still at a 4-week high, despite what they say. And that property prices are bottoming. Well, that's interesting because now we're starting to see the real estate market uptick, despite that people are looking at the mortgages and that market, they're still booming and they're still bottoming out there. There's still parts of the world and in the US in particular where property prices have bottomed and they're holding. Go look at Toll Brothers. These names, we've been talking about them for 6 months. So are we here? Maybe. And then you go through the rest of them, and I'm not going to go through all of it, but you get it. Increasing confidence. Well, we don't have that. Short rates are not at a neutral. Bonds are far from stable. You have the move at the top 3 level that it's been in 20 years. Stock market is not strong. Commodities are not strong. And I don't think prices are really picking up. We definitely don't have a boom mentality, right? So you can screenshot this, but I will put this in the newsletter and I'll get into greater detail. But I think this is important. It's going to lead to the next 2 graphs. Hey, did short rates peak? Okay, is confidence weak? Did inflation peak? Is production falling? Are short rates dropping? Are bond yields dropping? Is the stock market bottoming? Are commodities weak? Are property prices weak? So if I'm to look at this, the 2 scenarios here that make the most sense are recession, recovery, and maybe is going to be somewhere in the middle. This is from Stock Charts, and they did a really good job here. And I just want you to walk through it because this will explain it even simpler for everybody so that you can say it. Full recession. Are we in a full recession? I don't know. Are we in early recovery? Well, it kind of seems like maybe we are in a market bottom or early recovery the way that XLC, XLK is working, the way cyclicals are holding. Industrials are not doing that bad. But we're definitely not here, right? We're definitely not seeing that bull market top in energy, basic materials, and staples. And so then you start looking at the bear market and part of the early recession. Well, financial names are not lifting, are they? Right? They're not really lifting. And utilities are kind of lifting. I actually bought some utilities last week, but they're kind of lifting. So once again, when we look at these sectors, And you can compare all these. They all have their, XLK, XLB, XLP, XLU, right? You know them all. And we'll go over a bunch of them here in a moment anyway. But so you look at that and go, okay, well, what else can we take from this? Well, there's something here that I think you need to pay attention to. This green line is the economy. This red line is the stock market. So as you come through the early recession part, the stock market's dropping. As the recession is in your full swing and you're in a recession, what is happening? The market's getting stronger. See it? So the market actually gets stronger into the recession. This is historical. So what could be happening is we could be having a recession and the market could still go higher. Okay? And then the market could peak by the time that we understand that we went through the recovery. That's very possible. It's happened before. Now, this will tell you what you need to look for. Think of this as a cheat sheet. Late cycle, do we have decreasing growth? Are we in a recession? Well, that would be decreasing growth. Where are we with sentiment, right? And it shows you where you are in the cycle. Are we in the middle of the cycle with increasing growth? Are we near an early recovery? And then it will just tell you monetary indicators. Well, is the Fed no longer easing? Are rates flat? Okay, and you're starting to see these, and where are we? Well, corporate profits are a concern right now, aren't they? Okay, financial advice is less cautious. Not really. They're still telling you to be pretty cautious. Consumer confidence is kind of high right now, guys. Stock prices improve. Remember that Goldman Sachs index that we looked at, that bear market volatility index? So you start to look at these, and again, I'll go through some of this in the newsletter. So make sure you get the newsletter link in description, and I'll put it up here in the top right a couple times during this video so that you just click the link and get it as well. But if you take a look at this, and you start looking at the signals, it's real clear where you are. Okay, you're either in that recessionary period, entering that recession, or you're in the early recovery stage. And just a real quick reminder, whether we're in the early part of the recession, which is, quote, the bear market, or we're in the end of it, doesn't really matter. At this point in the stage, the market usually historically bottoms. So now we have a general understanding or basic understanding of the economic indicators and where we are in the cycle and what are the signs to look for that cycle. And again, I could do way more on that. So if you're interested in that kind of topic, let me know just in the comments and we'll cover it. But let's see if there's anything to that. So let's go look at that IT space and let's go look at communication services and what's going on over there. Well, this is something that I had in the newsletter and went through with the Alpha Chasers community. Huge upside potential, golden cross. Above average volume, relatively speaking, huge volume over the SOXX and XLK. That is a fact. Now, if we just click here on the daily before I get into the details, here's your golden cross. I look at these. Whether or not you want to look at those or is entirely up to you. I'll just point out and be Captain Obvious. This is where you had a death cross. This is where the 55, I use a 55, crossed the 200. This is where the 55 crossed the 200, okay? It's not rocket science. So which way are you leaning right now? You have net buyers, okay? Between the 50, 55 is where institutions usually will find some levels of support if they want to have support. And you are, when you break the 200, you've gotten rid of the last of the bulls. Same thing on the other side, guys. It works the same exact way, right? A lot of people, I just want to tell you this. This is when people don't want to give up and become bullish. And the reason they don't is because they missed the bottom. And the market doesn't care that you missed the bottom, right? And we don't know what's going to happen. And we have 20% of financials coming out this week. I think it's going to be fairly interesting. But if you take a look at XLC, this sure to me looks like something that is setting up to go a lot higher. But at the same time, you look at XLV and go, well, we just had a huge move up, which is healthcare. Well, all we really did was get to a resistance point and just stop dead. And I have zero volume down here, guys. There is just no volume. I'll pull that up for you so you can see. I'm not through any of my clouds or anything. You can say, oh, well, that's because there's always a reason why, because, right? Because, right? But here, no matter what, even though on that awful week, light volume week, we were still had above average volume, okay? Don't look for excuses. Just look at the data. Don't look for things to confirm your opinion. Look for things that actually challenge it, right? It actually makes you stronger as a trader. So we have data coming out. We're fully aware of that. We're fully aware that XLC is breaking out. We can take a look at utilities and see that they're starting to break out as well, right? So utilities tend to go towards the end, right, when the recession's just starting, and XLC is when you're starting to go through recovery. Well, they're moving. So there are signs of things that we should be taking a look at. Now, if we take a moment and just look at the XLK, and let's just look at technology names. Well, here's a golden cross. Again, let's not overthink here, guys. Okay, there's your death cross. Here's a golden cross. Okay, what has the XLK done since you had the death cross? Well, if you mark that off from the death cross here, and you just mark that from peak to trough, you got a 27% retracement. If you mark that from when you have this right here, and we'll use right here, we'll use that low. Okay, and we'll just go up, right? You're at 14%. Got a ways to go if you just look at historically what this kind of indicator means, and you'd have to go back historically through history to see what I'm talking about, but hopefully you get it. Now, it looks like a reversal to me on Friday. So I would be real careful here on saying that you know what's going to happen with earnings this week. Okay, we have Microsoft breaking out, legitimately breaking out of a flag after breaking out of a flag after a retest of the 50, after having what? A golden cross. So, you know, everybody trades differently. A lot of people don't put faith in those golden crosses. I would tell them to historically go back and back test what I'm telling you. And you can see it here as well. But I don't see how you're not getting up to 311, 312. I just don't see it. And this video is obviously going to be a little longer than most. So watch it in pieces if you want, or put me on double speed. But I wanted to get this all out because I know it's a long weekend. So if you look at these levels and you can see what's going on there, well, that definitely gives us something to concern ourselves with, right? Like, how could you be negative here? I mean, how much of this move do you want to miss, right? So everyone's waiting for the highs, the breakouts. You're staring right at it right now. You're seeing a new cycle emerge where they're talking AI. And Goldman had a really good piece on this where they said, listen, you're going to be hearing AI so much that it's going to make crypto, when you heard so much about crypto, it's going to encapsulate that. I don't know how you're not getting up to here. I see a bunch of people becoming bearish. Maybe, maybe not. Do semis look the best out of everything? No. Have semis had an enormous move? Yeah, this is doubled. You're up more than double from the bottom. So yeah, you've had an enormous move. A huge correction here would not be surprising at all. But do you want to make that bet? Because so far it's not working, right? That's not working. Okay, you're holding the top of that bar. Now, if you break that 264 level, maybe you have an issue. Maybe that's something you have to look at. Now, Tesla's a different story to me because of a couple things. Number one, when I start breaking and closing below the 55, I have no interest in being long until I'm above that level, right? So if I break that to the downside, I have to assume that every rally is going to fail. It's just the way that I will trade or swing trade. It tends to work for me on a probability basis, but we cannot get above that 200-day. And until you get above that 200-day, I would do very little there. You know, the SOXX is struggling with this 440 level. And so you're going to want to watch that. These are notes from the newsletter, the one I stated to get in the description. FRC issued a statement. They're coming out with earnings, guns blazing. So this should be really interesting. Friday, April 14th is the date that they have listed here. And if they're on time, it's going to be fireworks on Friday because a lot of people are waiting to see this one. And, this can go anywhere. I'm surprised, candidly, that they won't pre-announce before then, but, weirder things have happened. If I was them, I'd pre-announce either way. BABA got fairly good news. Obviously, we saw the breakout. This is a trade we did in the trading community, and you can just see the gap up and look at the close. So I would not sleep on this either. And I think we need to just review one more thing here because I find this fascinating, and just be aware of it because you have to look at the good, you have to look at the bad, right? And what you're looking at right here is the Q's relative performance to the SPY. Now, the reason that I want to look at this, and I'm just going to clean this off real quick, right? You can see the Q's relative to the SPY. Look where you're stopping. So I'd like to get through that. I'd like this outperformance to continue. You want the Nasdaq to outperform. I don't know that I'm going to use this, but I chart everything. So maybe I should be paying attention to that golden cross because it worked just as well as the death cross and seems to have worked back here pretty well, didn't it? So maybe it is something I should have on my radar, but it's not something I usually look at. And we should talk about JP Morgan and what's going on there. You're seeing the stock just kind of hang in there and chill. I think the issue with JP Morgan, and now again, you have earnings coming out, and earnings are going to be on Friday. As I've stated previously, 20% of all earnings are coming out of financials on Friday. Citigroup, BlackRock, it's massive. Friday morning is going to be massive. Now, if you see how we're acting in here, you're just sitting in here. To me, I think that the writing's on the wall that they're going to have to invest in a company somehow. They tried to buy SIVB. They were told no, apparently. There's a whole rigmarole about that right now. Now, 322, and we never got back to that 305, did we? Still under the 200, and the 55 is screaming, pointing down. So I don't know that I can get too excited about that. Now, if we take a look at something like Schwab, they issued a statement on Friday saying, look, we're going to have a conference call on the 24th. We have every single conference call that we have, and we're going to lay it all out there. Charles Schwab's being pretty aggressive. So I'm not really sure what else this guy can do, but he's made it quite clear that he can weather the storm. And I don't know why he would keep going out on the wind. If you couldn't weather the storm, the move is to throw the Fed under the bus. That's not what he's doing, right? That's the move. They did it, not me, right? So he's not doing that. But watch how this is acting, and I think that's pretty significant, and I think it's pretty important. And I would also focus on this. We talked about where you are in the economic cycles. Now, this is where you are in the economic cycle right now. This is the SPY, okay? This is the S&P divided by the 10-year. Where are you in the cycle right now? Well, the bond market's been outperforming for a period of time. Guess what's starting to happen? The stock market is starting to outperform the bond market. This is the first time we're starting to hit higher highs, guys. It has not been happening at all. Okay, since this started, this has not been happening. And it's starting to happening down here, and that's how it starts. And that's what you want to pay attention to. So I know we covered a lot today. Watch this video if you're having trouble with day trading right now. Comment on the length of this video as well. I know this was a long one. I could have done this in a couple different videos. But your comments are how I make content, and I got a lot of questions about economic cycles, and I could spend a lot more time on that. But just comment, let me know, and we'll go from there. Have a great weekend, everybody.